Most traders think scalping means predicting where the next big move starts. That's a recipe for getting chopped up. The truth is, scalping is about catching a tiny, predictable piece of a move that's already happening. You're not the hero of the story, you're the pickpocket. You take a small slice and you walk away. So here's what you actually need: the 1-minute chart, a basic read on trend structure, which just means knowing what a higher high and a lower low look like, and the Fibonacci retracement tool. That's it. No moving averages, no oscillators, no paid signal group. Now let me tell you why Fibonacci works so well on the 1 minute. The ratios, the 0.382, the 0.5, the 0.618, show up everywhere in nature. Seashells, galaxies, sunflowers, even the human face. And for whatever reason, the market respects them too. Price pulls back into these zones like they're magnetic, then continues the trend. Now, you might be wondering, why not just take the 0.382? It's closer to entry, it's a tighter pullback, you get in faster. Sure, but the trade-off is brutal. Your stop is wider relative to your target, and price tends to overshoot the 0.382 just enough to make it the worst level of the three. After enough backtesting, the truth is consistent. The cleanest setups, the highest hit rate, and the best risk to reward all live in the same place. The range between the 0.5 and the 0.618. That's the gold zone. That's where we hunt. Here's how the setup works. Step 1. Find the micro trend on the 1 minute. In a downtrend, you want to see lower highs forming. In an uptrend, higher lows. Not philosophical lower highs, visible ones. If you can't see the trend, there is no trade. Step 2. Wait for a break of structure. That's the moment price snaps the most recent swing point and signals that the trend is paused, not over. The break is your green light to start looking for a retracement entry. Step 3. Pull up your Fibonacci tool. In a downtrend, draw from the last lower high, all the way through the break, down to the start of the retracement. Same logic flipped in an uptrend. Step 4. Wait. Don't chase. Let price come back into the gold zone, the area between the 0.5 and the 0.618. Step 5. Enter in the direction of the original trend. Short in a downtrend, long in an uptrend. You can even split the difference and drop a limit order between the two levels so you don't have to babysit the chart. Stop loss goes at the 1.0 level. Take profit goes at the previous swing low if you're short, previous swing high if you're long. That structure alone gives you at least a 1-to-1 risk to reward, and most of the time it lands you closer to 1 to 1.5. The 0.618 entry is the sweet spot. Tighter stop, better reward, cleaner setups. Pause the video right here. 6 rules. Screenshot them. That's the entire setup. 1. 1 minute chart. 2. Trade with the current micro trend. 3. Wait for break of structure. 4. Enter on the 0.5 or the 0.618. 5. Enter at the previous swing low or high. 6. And if momentum stalls or the market is dead, walk away. The setup needs movement. Now here's the secret. But first, I want to thank our amazing community. I'll be rewarding the most heartfelt comments because that kind of support is what keeps me going and motivates me to keep creating free content for you. This week's winner is this comment right here. Please reach out to my email to claim your free month of Flux Charts. Now, if you haven't heard about Flux Charts yet, this is the platform I use every single day for my trades. It completely changed how I trade. Flux can run screeners on up to 15 tickers and timeframes at once. So instead of flipping through charts, it tells me exactly where my setups are happening. They have backtesting tools to build custom strategies and test them against years of market data in seconds, so you know if a strategy works before risking any money. Here's the best part. 90% of their indicators are completely free. Plus, you can use Flux Charts even with the free version of TradingView, which is huge because you can use multiple indicators simultaneously, avoiding TradingView's 2-indicator limit. They also host daily live trading classes teaching strategies, risk management, and trading mindset. Can't join live? They have a full library of recordings. Click the link in my description and use this code to discover the fantastic promotion I got for our community. Alright, let's get back to the video. When you set your take profit at the previous swing low or high, don't be greedy. Don't try to ride the move into next week. The market doesn't care about your dreams. Watch this. When price comes down and taps the previous low, there's a really good chance it's going to bounce and form a double bottom. That's just how the 1 minute behaves. Aggressive traders try to squeeze another 20 pips out of it and end up watching the trade reverse all the way back to entry, sometimes past entry. So you do the opposite. You go in already assuming a double bottom is going to form. You set your target a hair before the previous low. You let the trade close on its own. You collect your 1.5 R and you stop staring at the screen. Think about what that actually means in numbers. A 1.5 R trade that closes 90% of the time crushes a 2 R trade that closes 60% of the time. Every time. The math isn't close. Yet, most traders chase the bigger number because it feels braver. There's nothing brave about giving back a winner. The bravest thing on the 1 minute is taking profit while the market still wants to give it to you. This one mental shift will save you more trades than any indicator ever will. You're not trying to be right about how far the move goes, you're trying to be right about taking profit before the market changes its mind. That's secret number 1. Let me show you how this looks in practice on this pair. You see price rejecting a level, you mark it. You see another rejection and a clean break of the trend line. That's your break of structure. You pull your fib from the top of the move to the bottom. You drop a limit order at the 0.618, stop at the 1.0. Take profit just above the previous low. Trade fills. 7 minutes later, you're done. And if you want to keep going, you can. As long as that trade is alive, you repeat the process. Every new break of structure gets its own Fibonacci. Every retrace into the gold zone is a new opportunity. Some of these trades close in 2 minutes. You stack them up. A handful of clean wins in a row. Nothing crazy, just clean execution. But eventually, the market turns. And that's where most scalpers blow up. They keep forcing the same direction even though the structure has flipped. Don't do that. Which brings us to secret number 2. Your losing trade isn't just a loss, it's a signal. When you take a clean setup, perfect break of structure, perfect gold zone entry, and you still get stopped out, the market is telling you something. It's telling you the trend you were trading is done. The flip is happening. That stop loss is your invitation to start hunting in the opposite direction. If you were shorting all morning and the last trade stopped you out, stop looking for shorts. Start looking for longs. Same setup, same rules, just flipped. This is how you stay on the right side of the market without trying to call the top or the bottom. You let the structure tell you when to switch sides. One losing trade ends the cycle. The next trend pays for it many times over. That's why even a losing day on this strategy can still finish green. Picture this. You take a series of shorts in a downtrend. The winners stack up to 6%. Then the trend flips. You take one losing trade. That's down 1%. You're still up 5% on the day. Some of those trades closed in 2 minutes, some in 10. None of them took more than 15. And you didn't predict a single big move. You just kept taking the small, predictable pieces and you let the stop out tell you when to flip. That is 1 minute scalping at its finest. Alright, that's the strategy. 2 secrets, 1 tool, 1 time frame. All I ask in return is that you take 2 seconds out of your day and like this video. It really does help my channel grow. And if you want to learn how to backtest setups like this one before you ever risk $1, here's the deal. If I see enough of you in the comments below typing the word backtest, I'll put together a full guide on how to do this properly. Not a couple of weeks on TradingView, years of real data. No overfitting, no over-optimized nonsense. And the best part, I'll show you how to do it all for free and fast. So if you want the guide, you know what to type. Thanks for watching, and I'll see you guys next time.